Hey gang, sorry it's very windy out today. It's got my hair blown all over the place, and I hope it doesn't blow the phone. It just caught the rug and blew it across the patio here. Um, got some. This private credit is getting real scary. Well, not scary. I think it's interesting because I'm waiting to see what happens out of it. But to a lot of people, it's going to be very scary. A lot of people's got their 401ks wrapped up in this, and you might not even know it. It's wherever your company puts it, with whatever, and whoever's managing. Excuse me. Your 401k is where they're going to put it at. But um, there are these things called credit loan obligations. It's a CLO, and it's just renamed from being called a debt obligation of what we called it back, in '08. But now they call stuff different. They claim it's different. There's nothing different. Excuse me. It's all the same stuff. And one second. And these what they do is that it's just like your mortgages. Like they take these loans, they'll take like a bundle of loans that they've lent money to, and they got this bundle of loans here, and they'll put it in like a package or whatever, and then they sell it off. But what these private credit companies are doing is they're selling them off to one another, and they're just basically intertwining all these loans, where it's I wouldn't call it money laundering. I'm just going to call it loan sharking. But before '08, there wasn't real. There was private credit hardcore lenders, but they weren't as big. And after '08, the feds did. And that train doing something down there. The feds, they put all these policies in so that the banks wouldn't be able to do what they were doing before. Pretty much what these private lenders, private credit, hardcore lenders are doing now. And so the banks are regulated. And one second. Not a problem, man. You too, bud. I mowed his grass for him. It was real tall. He asked me to bring my riding mower around and knock it down for him. But back to what I was saying. These private credit lending is a big industry now compared to what it was, from the GFC. The GFC, I'm going to say it was. I think some of the numbers I've read, like it was in the billions. Like I'm trying to think here, like the capital they would use for stuff. Well, now we're into the trillions. BlackRock, Blackstone. All the big companies. So this thing is just pretty much it's banking, but it's private banking that's not regulated. Your loans are based on basically a handshake. You got stuff that's you're putting on the line to you're obligating that I'll pay this debt. If not, I'm giving that. It's the same stuff, but it's not the same as regular banking. And now you've got a company. Well, it's the Union Bank of Switzerland, USB Bank, and they are claiming that the default rate is about 15% with all these private credit companies, and which is why that the companies have issued stop holds or excuse me, stop withdrawals, or limiting on what you can withdraw. And as of I was just reading earlier today, and I was watching another guy on YouTube, and the Apollo has the highest default rate, and they're at 11%. And of course, BlackRock's at 9, Blue Owl Capital, they're at 8. But the thing is with these is at 7% default rate on their loans, the companies don't have the liquidity to cover their debts. Thus, they stop the withdrawals because they've got to keep, they tell me, well, BJ, we know you've got $1 million invested with us, but we can only give you, 45 cents on the dollar for what you got if you're wanting to withdraw your money, because we can do that. We're not FDIC insured. We're private, and we've got to keep that money to try to keep this stuff going. So you're getting a bank run basically on all these private lenders. Well, like I said, at 7%, that's where their liquidity rate stops, of where they don't have enough liquid to cover their debts. And then you got at 9%, they call it acute structural failure, and that's where things, it's not death, but you're right on that, acute, what that means, where it's coming on. And then at 12%, you've got complete collapse of everything. And they're claiming that their default rates are, under, outside of Apollo, this is at 11. BlackRock's at 9, Blue Owl Capital's at 8, and various other ones or whatever they're at. But then you've got the Union Bank of Switzerland claiming, oh no, they're lying to you guys. They're up to about 15%. And this has been going on for a while, because just like with everything else, the government, it keeps kicking the can down the road. These companies, they kept restructuring debt, restructuring this. You can only restructure something so many times until you can't do it anymore, and it just implodes on itself. And these loan payments just this year alone are at an 80% default rate, because a lot of these companies that got these loans, they got them back when the rates were almost, they were almost like 0%. And your hardcore lending is not like if I'll only use real estate for an example. If you go buy a house right now on a 30-year fixed, and you're going to pay 6.5 to 6 3/4 if you got good credit. Now, on a hardcore lending, like if I'm wanting to buy a house for the purpose of making a rental, then I'm going to pay at least a minimum of 2 points or 2% above prime. So, or 2% above the current 30-year mortgage. However, when you do hardcore lending like that, like if you buy a rental, your loan structure is based over a 20-year payments, like your amortization schedule. But the loan is set up for either 3, 5, 7, and sometimes you can do a 10-year loan. Well, when rates were real down, that was 6 years ago, 5 years ago. So all these loans are having to be, readjusted based on what the current rate is. And they're not, and these companies that took out these loans are not able to make their payments, because 0%, why wouldn't you go get money? I mean, it's cheap money. You're basically paying nothing on it, and all you gotta do is make a profit. And you're going to make a profit if you're not paying hardly any interest. But as these loans keep coming due, just like with people's mortgages that took these buy down rates, for X amount of years, or ARM loans, they're all going to start coming due. And a lot of these are coming due now from the people that first bought into the very end of where they were like 0%, or wherever they were, and now they're up here, and their payment is going to be, your payment could double, could triple on some of this stuff. So that's why you're getting all these default rates, and it's going to get real nasty. But the funny thing with a lot of these CLOs, like I said, credit loan obligation, it's debt. It's a debt loan. They're insuring these packages that they're selling off to one another through insurance companies that they own. And when the rate hits 12% confirmed default rate on the loan payments, the insurance companies have to kick in to cover whatever it is that they're doing, and they don't have the money for that. But your insurance companies are regulated by the government, So what's going to happen is these insurance companies are going to be forced to liquidate those loans. And what have all these big companies been doing, and they're trying to put a stop to it, is banning institutional buyers, Wall Street, from buying all these properties. And I think the last one I heard, it said that Wall Street owns a little over 1 million houses. Well, when you have to liquidate something because, you know, you're either going bankrupt or like all this default stuff here, then and they own, let's say that they own a bunch of houses in an area, they don't just get, you know, they're for sale, and they're not put on like the MLS and, you know, just listed and wait for them to sell. No, you got to sell them for whatever you can get out of them at that time. And they're going to be taking huge losses on these. And as these houses, you know, like if you got a $500,000 house and they're forced selling it, you might get 300 out of it. I mean, if you're lucky, because if you got a whole bunch of them, that's a lot. That's a lot of spending to go on, which that's going to in return piss off the people that's got properties in these areas and they got their values. What are you barking at, Bubby? If I've seen a bird or a squirrel, but you know their values are real high, and you know, like a lot of the big cities, you know, BlackRock has bought into them places. And a lot of them places contacted me wanting to buy my portfolio. What was it? Oh crap! I just got a mind blur because I had they send little postcards wanting to buy my house and buy all my rentals and all that crap. But Truehold, that was another one. Matter of fact, that guy called me on the phone, and but they're going to be forced to liquidate all these properties, and as they sell them for whatever they can get out of them, like forced sale, not waiting to sell, but forced sale, it's going to pull all these other houses down. So, you know, like I was telling you in my last video and prior, you're easily going to see 30% drop when all this stuff happens. Don't be surprised if you see 40% drops in places of these houses going down in price. 50, 60. And it gets real bad, you're going to go 60 plus. But it's going to be interesting watching all this stuff go down. And the thing is, I've told people, I don't want anybody to be, you know, like, you know, stunned when it happens. Don't be surprised when all this stuff goes down. If you got 401k money that most of us wiped out and you don't get it back. What I was listening to and digging into this, they're kicking these cans down the road, and we could be looking, if we're lucky, a couple months, but they're talking weeks that this stuff's this stuff's ready to go down. You know, so we're gonna see what happens with this, and by the time stuff hits mainstream media, it's already happened. It's a done deal. So there's gonna be a lot of people that's gonna have sticker shock when all this goes down, and they got their house listed for sale, and you know, homes.com or whatever like I said, the ones that are buying up all the houses, when they go, well, I can't sell my house for what they're selling that for. They're being forced to sell that. I owe more on my house than what they're getting out of that. You're going to see that. Then you're going to see a lot of job losses pile up too. You're going to see a lot of layoffs, like mass layoffs, and it's going to happen like it did in 08. Just keep watching. Like I said, this week's getting good. And when I see stuff, I'll let you guys know. But you can look into this. Like I said, they're called credit loan obligation, CLOs. And it's funny that you got like the Union Bank of Switzerland. They're based, of course, Switzerland is in Europe. And they're claiming that the default rate is this high when our companies are claiming it's this high. So somebody's lying somewhere. And I'm almost going to bet that it's our people that want this lying about it. So it's gonna be interesting, and you're gonna see a lot of money loss in this, and a lot of these private credit companies won't survive. Will BlackRock, they're the largest, will they survive? I don't know. Probably. They got a lot of let's just say they got a lot of fingers in the politicians' pockets, and they got connections up there. So don't be surprised if us, the taxpayer, gets shoved over on us to a point that, like I said, I've done digging. I even asked AI, can the government sustain, sustain another '08 type bailout? And yes, they can do it, but can they sustain it? No, because there's already too much debt, from then, from COVID, and they won't be able to afford the payments. So they're going to do what they have to do. The only way you would not see interest rates go up is if we have a complete collapse of the private sector and everything, which at that point you're going to have deflation because people don't have money. Nobody's going anywhere. Like after, I think it was in 2009, gas prices dropped to like $1.50, $1.59, because everybody laid off. Nobody doing anything. Only people that had money was able to go and do stuff. And I remember Dayton, in particular, right before all the layoffs kicked in, it was packed. I mean, all the time packed. And after all the layoffs happened, it was like a ghost town. It was like going through there at nighttime. Was how dead it was. So keep your eye on this stuff, people. I'm going to keep watching it because I'm not invested with any private credit per se outside of crypto. I mean, if I don't think that it would collapse the crypto exchanges. I know Coinbase is the largest one, but we'll see what happens. And but like a lot of times, this is where millionaires are made. This is when bad times happen. Cash is king, and you buy this stuff. I mean, heck, I was buying houses. One of my houses I bought, the 3-bedroom, 1-bath, 3-car garage. It was a HUD foreclosure. I paid $19,000 for it. No, well, it wasn't turnkey ready. Excuse me. Ooh. I had to go and I put windows in it. I fixed it up. It wasn't a lot of work, but I did a lot of work to it. But this is where millionaires are made at. Billionaires. If you got the right stuff. I'm sorry about my hair. It is windy out here. So hope you guys keep your eye on everything. And if I see anything else, I'll let you guys know. Like my page, like my channel, subscribe to it, share my video. That's the best thank you can give me. I'll see you guys next time.